Hello? Hello? Excuse me? Hello? Hello, excuse me? Hello, excuse me?
Hello, miss. We can't hear you. Hello, Miss. Hello. Good evening. We can't hear you.
Hello, now okay. Hello.
Thank you very much. So we'll start with the cost of capital, right? Last week we stopped at the cost of capital. So then we'll start with the cost of capital today now. So good evening. So make the heading cost of capital. Right. How we can, what do you mean by the cost of capital? What is mean by the cost of capital? So this is the cost that the company is going to incur for the on behalf of the equity that they have collected, right? The companies have the companies have the two type of two types in gaining the equity. The first one is the internal equity, generation of the internal equity, and then the other one calling for the external equity, internal and the external equity. Right. So what do you mean by the internal equity? Internal equity. Internally generated common equity. Right? You have given here the is retained earning. How the company can raise capital? Company can raise capital with the retained earnings. To have that idea, first you need to clearly identify the retained earnings. What do you mean by retained earnings? The accumulated profit. The accumulated profit for the company, we can call it as retained earnings. We annually, what we are doing is we accumulate this profit annually. Right? So then how we can convert this retained earnings to the capital? Yes, how we can? Yes. Again, equity is under the equity. Equity can be shareholders. Equity can be divided into basically two. What those are? Reserves, and then the other one, shareholders equity. Right? Shareholders equity. Retains can be divided into, or else reserves can be divided into three. What those three? Retained earnings, general reserves, and then the other one, revaluation reserves. Right now we have retained earnings, profit, accumulated profit. How you can convert this accumulated profit to the capital? When the companies are issuing the bonus shares, or else if they have the accumulated profit, what they can do is rather than going with external sources, they can do the internal capitalization, or else they can capitalize the retained earnings that they have. Right? So therefore, the method of the capitalizing the retained earnings or retained earnings is a bonus issue. Companies can issue the bonus issue and then capitalize their retained earnings to the capital, or else capitalize their retained earnings into the equity. We call it as an internal generated equity, or else internal generated common equity. Right? External equity means if the company doesn't have any accumulated equity, what they can do is they can go with what? They can go with the collection of the funds from the outsiders. We can identify it under the external common equity. External common equity. Is that clear? two methods are there. What is the first method? Issuing new shares, and then the other one, capitalizing the existing retaining earnings. So if we are going to the retained earnings, we have to calculate the KE under the several methods, and then if we have the new common shares, issuing the new common shares, we have to another identify the separate method to calculate the KE. If the companies are going to issue the, or if the companies are going to capitalize their retained earnings, they have to identify it and they have to calculate KE with the opportunity cost method. What do you mean by opportunity cost? What do you mean by opportunity cost? You have tested that one in the economic subject. Yes? Among choices, we make the best choice. So then if we are making the best choice, there might be several options which needed to be followed after this best method. Right? So we have an opportunity for cost. Right. So then if a company is going to issue the, or if the company is going to capitalize their retained earnings, they are losing these retained earnings. Do they have opportunity cost on this retained earnings? If the company is going to capitalize their retained earnings, do they have an opportunity cost? Yes, they might have. Well, rather than going the investments, or rather than going this capitalization, by taking this retained earnings, they can go to the investments. Are they going to miss something? Yes. We have to assume we have 1,000 rupees as a retained earnings. We need to capitalize, we have 1,000. Then what we can do? We can capitalize, we have two options. Right? The first option is you can capitalize this 500 out of this 1,000 and utilize it to the equity. That's the one option. First option. Second option, what is saying? No need to go with the capitalization. Out of these 1,000, we take 500 and we can invest in a new project. So you have two alternations. First one, capitalization. The other one, go with the investment. So therefore, if you select capitalization by 500 rupees, do we have an opportunity cost? Yes, we have. What is it? We losing the investment. We losing the investment. How 500 rupees we invite sometime it might generate the income for us. So therefore, you have an opportunity cost. If you are taking the capitalization, if you are taking the retained earnings capitalization, definitely you have what? You have opportunity cost of which one? Common stockholders fund. Right. To calculate this opportunity cost, to identify this opportunity cost, we use three methods. What's the first method? We identify this opportunity cost under the dividend discount model, and then the other one, what is it? Capital asset pricing model, and then the other one, bond yield plus risk premium method. So these are the three methods, alternative methods to identify the cost of internal common equity. Okay. Now make the heading cost of internal equity. Cost of internal equity, and that one write it down. First one, dividend growth model. Dividend growth model. Under the dividend growth model, how you can calculate the cost of equity? KV, dividend in the first year divided by the P0 plus growth rate. That means if you are not going with the internal generated commodity, or if you are going with the internal generated commodity, you lose the investment in the other company. So therefore, you can calculate this internal common equity opportunity cost by dividing dividend in the first year with the P0 purchase price and then add the growth rate. Good question answer. You have given the market price and then you can identify just pay dividend is 4 and then ROE payout is 60 and then internal common equity. Here you have to apply the method of calculating the growth rate, that is ROE multiplied by the retention ratio. You have to calculate the retention ratio and then need to identify the growth rate. Once after you identify the growth rate, apply that growth rate to the just paid dividend and then calculate the common equity, cost of common equity. Try to do it. First, identify the growth rate. Growth rate equals ROE multiplied by the retention ratio. Right. Growth rate, ROE, how much is it? ROE is 10%. Retention ratio, you have been given the payout ratio, that is 60. So then, what would be the retention? You once after earn the 1 rupee, out of that one, 60% is going to be payout. So therefore, definitely remaining 40 or 4%, 0.4 is the retention amount. So therefore, retention ratio would be 40. So then growth rate equals 4. Growth rate equals 4%. Am I right? Now, apply that growth rate to the just paid dividend. Am I correct? Is that 40? 4%. 4%. The growth rate ROE multiplied by the retention ratio. Retention ratio is ROE growth rate is then calculate DIV1. How you can calculate dividend in the first year? Dividend in the first year. Tell me the way of calculating dividend in the first year. I write it down. DIV in first year. Write it down. Dividend, write it down. Dividend in the first year. Do it with me. Dividend in first year equals D0 multiplied by 1 plus growth rate G to the power 1. To the power 1. Second rule applied now. D0, how much is it? Just paid dividend? 4 rupees. 4. 4 rupees multiplied by 1 plus R. R is how much? Sorry. 1 plus growth rate. It should be growth rate. Right? It should be growth rate. Sorry. It should be growth rate. Other phone අපි යනවා දැන්. හරි යනවා. අපි ඊළඟ එකේ ප්‍රින්ට් කරගමු යනවා. දැන් පොඩ රිලැක්ස් වෙන්න. දැන් ඉන්ට වෙන්න. හරි. DIV1 කියන සෙවොන් DIV1 එතකොට කොහොම ඉන්නෝ DIV1 take out your calculators 4.16. Write it down 4.16. Now apply that DIV1 with the purchase price. How much is the purchase price? 30. So then write down the formula. Write it down. KE equals DIV1 divided by P0 plus growth rate. Now second line apply. Then over 4.16 divided by 30. divided by 30. 1 plus 0.04. Tell me the KE. 0.178. That means 17.8. 17.8 is the answer for the KE. Online students, did you got the answer? The answer is 17.8. Online students. Online students, you got the answer 17.8. You got the 17.8. The answer is 17.8%. Okay. Right. Now, boys, make the heading common equity, cost of common equity. You don't need to write it. More than cost of common equity. Cost of common equity. And the next one, write it down. Internal common equity. Cost of common equity, KE. Cost of common equity, KE. Within brackets, KE. KE. And that one, write it down. Cost of internal common equity. Cost of internal common equity. Cost of internal common equity. Keep at least 7 rows. 7 rows. First mark it before the 7 rows. Once after you complete the internal common equity, first heading, dividend growth model. Dividend growth model. Dividend growth model and keep 7 rows. That is what we have discussed so far. Then make a dividend growth model tamai first method. Right? Keep 7 rows and write it down. Now what is the other method? Capital asset pricing model. Capital assets pricing model. Now all you need to write. Second method. Second method, capital asset pricing method. How do you begin?
එතකොට මේ ඔසල පිස්නේ මොලේ දාන්න business traffic
Professor Ginder.
Professor out to another chances.
Professor Nami Yana me. Because feels like good guarantee. Professor Ariel Dhamma to. Professor Srilanka and then. Yes. Start with it. Oh. Finance again, my day. And it's speaking again. Right, okay. So we lectured this one previously also capital asset pricing model. Then we have the formula. 9,000 formula capital asset pricing. Okay, but it identifies. It identifies the cost of common or else the KE, cost of equity, intergenerated common equity. How it consists with risk-free return. What do you mean by risk-free return? Risk-free return, the interest or it's the return rate that you are receiving on the treasury bonds. Treasury bonds should be added to the, it should be added by the beta. What do you mean by beta? Market risk, and then the, what do you mean by the risk? What do you mean by here? Marketable securities return minus the risk-free return. This is called as the risk premium. Right, risk premium. Adjusted beta should be added to the risk-free return rate that gives us the cost of equity under the capital asset pricing model. We discussed this one in the last session of the risk and return. So another alternative method to calculate the internal general common equity. That is simple method. Okay. Do the question number 6. Read the question. JH PLC beta is 0.92. Beta means BE. Right, and then 0.92, and then yield on the long term treasury bill is 6. That means risk-free return, that is 6%. And then market risk premium. Risk premium means this part, right? That is 4.5. So then you need to calculate the cost of stock. 0.06 plus 0.92 multiplied by risk premium 0.5. 0.45. What is the cost of equity? Okay. Yeah, calculate the cost of equity.
Zero
0.0,
0.441.
This is the first method. You have to first calculate this one and then add that part of the 0.06. Zero point 0.101. That means 10.1. That's the answer. Right? Cost of equity and the capital asset transition, we can calculate it as the 10.1. Okay. The third method, write it down. Third method, bond yield plus risk premium. Bond yield plus risk premium method. We are not going to in detail discuss this one, bond yield plus risk premium method. So under this method also you can calculate the cost of equity. Again, risk premium should be added to the long-term bonds yield. That means return. Return on the long-term bond should be added by the risk premium under this method. Okay. Question number 7. Try to do the question number 7. It's very easy. Even you cannot capture the first method, now you can do it and then have idea regarding the first method. Oh. මේ පාඩම නම් ඔයාලගේ මෙච්චර කල් මම මේක මේ compulsory question එකට දාලා තියෙනවා. මේක මේ lesson එකයි තව lesson එකයි දෙකම එකට දාලා තමයි තිබ්බේ. දැන් සෙක්ස් අතර අහක් ඇතුලේ එහෙම ලකුණු 28කට මේ පාර ඒ ගාන වෙනස් කරනවා. compulsory ගාන වෙන එකකින් and the structure එකයි හැමදාම දෙන්නේ පළවෙනි question එක compulsory question එකක් ඉතුරු questions වලින් questions 7ක් දුන්නා මම 18 week day කටින් මේ පාඩ questions 7න් questions 4ක් තෝරගෙන ලියන්න තියෙනවා තුනක්ම කාරියද පොඩි පළවෙනි question එක compulsory කියන අකුරක් හරි ලියන්න බිඳුවක් වුණා ඒක දුන්නේ lessons දෙකක් එකට එකතු කරලා question එක scenario එකක් දීලා එහෙම තමයි දුන්නේ මේ පාර දැන් ගොඩක් හැමදාම එක දිගට capital asset cost of capital එකයි investment decision එකයි දෙකම එකට merge කරලා දෙන්නේ. පාර වෙනස් කරන්න තමයි ඉතාලි. වෙන මෙතන වෙන ගාණක් දෙන්නම් compulsory question.
Yes, ma'am.
පාට කියනවා ඒ ගාණ. compulsory question එකේ lesson එක මම කියන්නේ. ඒ කියන්නේ Why will the definitely have it? Paper ලියන්නේ. දැන් theory questions උත් තියෙනවා ඔයාලගේ හැම question එකකම. අන්න theory question එකක් තමයි. ලකුණු 5කට හරි 6කට theory question එකක් තියෙනවා. question ලකුණු 18 questions තියෙන select කරගන්න. ඉතින් ඒකේ ලකුණු 5ක් අනිවාර්යයෙන්ම දීලා තියෙන theory ලියන්න. ඔයාලට ලකුණු 40ට වඩා වැඩිපුර ගත්තොත් grade එකකට යනවනේ. එහෙනම් 41 ගත්ත එක්කනට B එකක් යනවා. continuous set වෙනවනේ. 41ක් ගත්තා. 39ක් આવොත් එන්නේ 39ක කියන්නේ සාමාන්‍යයෙන්. බයන් 39ක continuous set Vale, vale. Question numbers टिकल ये ला मैं blank चल है Okay, do it now, do it. Now you all can do the past papers on the not first question, 2, 3, 4 questions. Risk and return, do it. Same set of question, risk and return, same set of question. So this time I told to include the risk and return question as a compulsory question for the 28 marks. Today, the 8%. It says the 12th week, no? No, 11th week. That's one. Subject එක හරි ලේසි. ගණන් හදන්න තියෙන statistics එකක් ඔලුවට දාන්න. හිතන්න දෙයක් නෑ subject එක. හිතන්න දෙයක් නෑ අර. ගිරා ගන්න පුළුවන් නම් ඒත් හරි subject. ඔයාලා හදලා practice වුණාම එතනින් ඉහළ ලොකු දෙයක් නෑ මේක. ඒක වගේ නෙමෙයි හිතලා ලියන්න කියන පාඩම් කරන්න ඕනේ නැහැ.
मैडम आप
දැන් පරක්කුණා conversations වලට එන්න පරක්කුණා.
next week හැබැයි මේ දෙකක් තුනක් ඉවර වෙනවා.
එච්චාරි ඉවරයි ඕනේ. උම්මයි දුතුයි. Did you say? Then this last week good to get. Serial mistake finding get silver kara. Presentation stand over at your presentation stand. I have not even a crime on the system. Give us a game again. Balance කරයි එන මගේ sessions දෙක අතර එක දිගට දාලා balance කරයි. මම කොහොමද ඔයාලගේ presentations ගන්නේ නැහැ. ඔයාලගේ video document තියෙන මම ඒක බලලා evaluate කරන එකයි කරන්නේ. එතකොට මම ඒ link එක right. අසල් කියලා දානවා කියලා කියන්නේ theory නෙමෙයි. තියෙන past papers ටික cut එකතු කරලා හදන්න. අන්න right. ඒක තමයි. Risk and return ගන්න වලට හදන්න පුළුවන් මේ ඔක්කොම cover කරලා තියෙනවා. Financial system පුළුවන් නේද? Time value of money පුළුවන් නේද? theory ප්‍රශ්නයක් තියෙනවා. පළවෙනි නෙමෙයි දෙවෙනි segment B පළවෙනි ප්‍රශ්නේ theory ප්‍රශ්න. Financial system සහ introduction to finance. ලකුණු 18ම පාඩියක් තියෙනවා. ඔව්. ඒක නෝ තාම past paper එකක්වත් බලලා නැහැ. මම කියන්නේ එක දෙයක්. Recently past papers දෙක print out ගන්න. Print out ගන්න. As a practice print out එක ගන්න අපේ තියාගන්න. ඊළඟ lecture එකට. ඒක පළවෙනි question එක කරන්න එපා වුණාට මම මේ පාරේ පළවෙනි question එක දෙන්නම්. ඔයාලට එකක් ගන්න පුළුවන් පළවෙනි compulsory question එක අමාරු කියලා හිතන්න. උතුරු questions වලට select කරගන්න තියෙන්නේ. ඒ ටික ලිව්වත් ඔයාලට එකක් ගන්න පුළුවන්. 40ට වැඩි නම. ලකුණු 50කට reach කරගත්තාම ඔයාලට එකක් එනවා ගොඩක් වෙලා. Let's strategically apply කරන්න. आप කොහොමද apply කරනවද strategy. ඔහේ ලියනවද ලියලා හරියන්නේ? Predictor තිබුණත් අපි session එකක් කරමු fast paper කරමු. මම කියන පළවෙනි ප්‍රශ්නේ පාඩම. Beta value 1.2 and then market risk premium is 8% and then risk free rate is 6%. So then it identified the capital asset pricing model descriptions. Capital asset pricing model. CAPM model. Right? KE identified as the CAPM model. First you need to take the what is the formula? Risk free return plus beta adjusted expected return of the marketable security minus risk free return. Risk free return is 0.06, beta is 1.2, and then risk free return is 0.08. Calculate the KE 0. KE equals 0.156. That means 3.0. Second part, it gives us the dividend calculation of KE and the dividend growth model. Dividend growth model. Then KE, cost of equity, equals. How you can calculate? PIB 1 divided by target dividend. Asset. PIB 1 divided by P0 purchase price. Needed to be added the growth rate. Around growth rate is how much? Growth rate is 8%. DIV1 last year dividend, how much is it? That is 2. Last year means it need to be grown this year. So therefore, we have 2 multiplied by 1 plus growth rate 0.08 divided by, divided by 30. That's 0.08. What is the rate? KE again 0.152. Or else it can be identified as the 15.2. But we have discussed capital asset pricing model and dividend growth model. Using these 2 models, you can calculate the cost of equity. Right? Cost of equity. Which cost of equity? Internal generated common equity. Company එකක් තමන්ගේ capitalize කරන්න යනවා නම් තියෙන equity එක මේ methods දෙකෙන් ඕනම method එකකට ඔයාලට ඒ calculate කරන්න පුළුවන්. Right? Let's need also upload the LMS. ඒක upload කරලා තියෙන LMS එකේ. බලන්න කියලා. අයියෝ print එකක් දෙනවා. මොනවාද formulas දෙනවා PV tables උත් දෙනවා. අම්මේ එතකොට ගෙදරින් print කරන්න අවුත්. ඒක ලියනවා. කොපි කරනකොට කියන්නේ කොපි කරනකොට මෙහෙම අදත් බලන්න මෙහෙම පෙන්න. හරි ලැක්කම් පිටින් ගෑනු ළමයි. ළමයි කොහොමද ස්කූල් කරන්නේ? ළමයි කොපි කරන්නේ. මෙහෙම පෙන්නගෙන ඉන්නවා. ඉතින් පාඩේ පාඩේ ඉතින් පාඩම් කරගෙන බය. මන්දරනේ මම ගැටේ පිටිපස්සට. Okay. You have what write down. Second one. Second main method. Write it down. External common equity. External common equity. External common equity. Right? How you can now the other case is different. Right? Previously, what did we identify? If the companies they are going to capitalize their internal generated common equity. So they have 3 methods. Now they are going what they are going to do is they are going to issue the shares. Right? If the company is going to issue the shares, how they can identify their cost of equity? Yes, if it is a normal growth dividend, so how you can identify? DIV1 divided by P0 multiplied by 1 minus F. What do you mean by F? Write down the formula, Leo. Write down the formula. You can finish the lesson investment decisions since you have already identified the PV calculation and IRR calculation. So you already identified those things now? Okay. DIV1. DIV1 means first year dividend. divided by P0 adjusted the flotation cost. What do you mean by the flotation cost? F means flotation cost. F equal flotation cost. F not EA, I know it. Flotation cost. What do you mean by flotation cost? If the companies are issuing the shares, definitely they have to identify some legal charges. They have to pay some brokerage fees. And likewise, there might be some initial costs that they need to expense or that they need to utilize on issuing shares. We call it as a what? Flotation cost. So therefore, even we identified the purchase price, you need to adjust that flotation cost since that is an expense to the organization. Therefore, P0 after they adjusted the flotation cost needed to be considered on the calculating of cost of equity, and then you have to add the growth rate for the KE to calculate the KE. To the question number 8. Left.
Is that? Okay. I gotta do it.
Okay. Hassan, individually seen. D1. What's the D1? D1 is 4 years. No, 30. Below located 30. 4. Is that 4? You have to apply that is what? That is just paid dividend. Just paid dividend means D0. Right? D1 means D0 should be multiplied by 1 plus growth rate divided by the P0. Right? P0 Adjusted one minus flotation cost plus growth rate. Right? D0, how much is it? 4. And then growth rate is how much? 8. So therefore 0.08 divided by 30. That is 1/30 cubic price. And then additional flotation cost. How much is it? 12%. Therefore adjusted flotation cost adjusted. Purchase price or market price needed to be identified and then at the growth rate 0.08. What would be the value for the KE? 0.243. K equals 0.24. That means 24.0. Just paying dividend means D0. There is a difference between D0, D1, D2, D3. But those difference can be how those difference can be identified because of the growth rate. Clear? Right. Now we move to the other concept, weighted average cost of capital. Write it down. Write it down. Weighted average cost of capital. Write it down. Weighted average cost of capital. Within brackets, that is WACC. WACC. Weighted average cost of capital. Within brackets, that is WACC. WACC. What do you mean by the weighted average cost of capital? What have you identified so far? We identified KD. Did we? Yes. We identified cost of equity today. We identified cost of preference shares again last year. So these are what? These are the costs that the companies are going to pay for these outsiders. How can we identify the overall rate that is calculated via the weighted average cost of capital? By combining these three, you have to identify the average cost that we are paying for the outsiders. We call it as one weighted average cost of capital. KD to the higher given of KD to the higher given of KP to miss given. And overall rate in key the later given. How can we identify? Yes. How can we identify? For the debt, how much you are paying? 10%. Right? For the cost of equity, how much you are paying? 10%. For the preference shareholders, we need to pay 20%. All these are outsiders. All these are fund providers. How you can identify the weighted rate for these fund providers? How? That is why we are calculating weighted average cost of capital. Now quickly draw this one equation. KD. Write down these three circles. KD, write it down, cost of debt. KD means cost of debt. KD means cost of debt. Cost of debt. KE means cost of equity. Cost of equity. KE, cost of equity. Cost of equity. KP, KP means cost of preference shares. Cost of preference shares. 15, 15, 16. Cost of preference shares. Middle, write it down, weighted average cost of capital. Make an arrow and write it down. We need to identify, write it down below the diagram, below the figure, write it down. Company pays, KD, 10% for the debt providers. Come on. KE for the debt providers, debt, 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 debt providers, comma, KE, 10%, KE, 10% for equity providers, and KP, 20%. KP 20% for preference share holders. For preference share holders. Next line, full stop, next line. Preference share holders. If the company, write it down, if the company is paying this much of, cost, this much of cost for the fund providers individually. It needed to be calculate overall slash average slash weighted cost. It needed to be calculate average, overall, or weighted cost, which name as weighted average cost of capital. Minimum weighted average cost of capital. Minimum මේ වගේ ගෙවනවා. හැබැයි අපි ආයතනයක් විදිහට බලන්න ඕන අපි කොච්චරක් එළියට ගෙවනවද overall rate එක කියලා. මේකයි calculate කරන්න යන්නේ. Right. How we can calculate? How you can calculate? Write it down, next slide. In calculating weighted average cost of capital, in calculating WACC, next slide. In calculating WACC, we need to consider capital structure of the organization. capital structure of the organization. Capital structure of the organization. Next slide. Write it down. Capital structure equals. Capital structure equals. Within brackets, write it down. Firm value. Firm value. For the capital structure, write it down. Firm value. Firm value equals. එකම වචනය capital structure හරි firm value එකක් දෙන්න එක. Equals. Value of equity shares. ලියන්න යන්න පුතේ. Value of equity shares. Value of equity shares. Within brackets, E. E. Capital E. Plus. අපි මේ බලන්නේ capital structure එක හැදෙන විදිය. Right? Value of equity, E. Plus. Value of preference shares. Value. Value of preference shares. Value of preference shares. Within brackets, P. Preference shares, P. Preference shares, P. Plus. Value of debt. Value of debt. Value of debt within brackets D. Next line. Now write it down. Next line. V equals. Then V equals. B. Capital V equals. Then the firm value will be B. සංගලවරන්න දාගන්න preference shares සහ equity shares වලට දාලා E කියලා ලියන්න. It should be like this. V equals यावाले components එකක් ඇතිනේ preference shares and E plus P. E plus P equals E plus and then P. Firm value equals equity capital value plus the other one debt capital. Now we can keep the weight. Hope it is clear. Okay. Right. This is how you can write down the weighted average cost of capital. I write it with me. Write it with me. Weighted average cost of capital equals. We have three components. First one, what is the first one? Cost of equity. We have calculated it. And then second one, we calculated the cost of debt. And then third one, we calculate the cost of preference shares. These are the individual rates already calculated. In identifying average cost, you have to identify now the capital structure. Equity given firm value equity measurement. Right? We have to identify the capital structure. For how much out of this firm value we are paying for this KT. Right? Cost of debt. Definitely you have to consider the cost of debt after you apply the tax rate. Right? When identifying the cost of debt, you have to consider out of the firm value, how much is belongs to the debt providers. Right? The other one, KP, we are paying KP for this much of preference share value out of the firm value. You already keep the rate. 110ක් ගෙවන්නේ ලක්ෂ 10ක shareholders කට. 110ක් ගෙවන්නේ ඉතුරු 110 ගෙවන holders කට ලක්ෂ 50කට. නැත්නම් ඉතුරු 10 ඉතුරු 20 ගෙවන්නේ ලක්ෂ 100කට වෙනවා. එහෙනම් යා මොකද කරන්නේ? We need to pay that. Hope it is clear to you all. Any questions? Right. We'll go to the question number 9. Do the question number 9. Okay. Question number 9. Question number 9. Oh.
Asan.
Go ahead. අර ගෑනමේ පොත පෙන්නනවා මේ අදියා. අංගලයි පොත ඔකලේ පෙරදී මේක ඉස්සෝ.
Never do that.
Company issue කරන්නේ separation transfer. Company issue කරන shares ගන්න ඒ cost එක තමයි ගන්න. ඕක දිහා බලනකොට ගන්න නෑ ඕකේ. ඕකේ දෙවෙනි කෑල්ල ගන්න තියෙන්නේ. ඉතරකේ ගන්න කියවා. We need background information for the question in the next section. It's next page. Yes. For as a cost of preference shares, how much is paying 13%. Cost of debt 11%. Cost of equity, if it is internal, how much is it? 17%. And then if they are going to choose the shares, that means external, it is the company is going to issue the internal share. Also, the company is going to capitalize the internal retained earnings. That is the 17%. Rather than doing this, if they are going to issue the shares legally, how much they need to have a cost? You share 17%, the external internal retained 16. Internal directly given the cost of external equity. Now what it does? These are the individual rates, right? What is the average rate? මේ ඔක්කොම එකතු කරලා එකක් විදිහට ගත්තොත් කීයක් ගෙවනවා? නේද? How you can identify AP, cost of preference shares, we have cost of debt, and then cost of equity. Preference share needed to be considered after the tax. How you can identify this weighted average one? By applying the capital structure as the weight. Capital structure. KP, value of the preference shares divided by the entire value, and then value of the debt divided by the entire value, and then value of equity divided by entire capital structure. AP, how much is it? 13% or 0.13 multiplied by, tell me, value of preference shares. Yes, next slide. It include in the next slide. How much is it? Assume that total capital requirement for the ABC PLC is 100,000. The ways of acquiring this 100,000, 40% debt, 20% preference shares, and then the 40% again common equity. And they have specified that the company is issuing the new shares. Assume they are going to issue the new shares and then capitalizing their retained earnings. Then මේ විදිහට ඒගොල්ලන්ට සල්ලි ඕනලු. ඔක්කොම ඕන ගන්න කීයද? Capital structure, how much is it? How much is it? 100,000. Dili pa ganno na 100,000. How this 100,000 required or have been comprised with 100,000? This is what? This is value of the firm. Value of the firm. It comprised with 40,000 debt, and then 40,000 equity, and then remaining 20,000 as preference shares. This is the capital structure, right? And now keep it as a weight. Out of these 100,000, how much belongs to the preference shares? 20,000. See the capital structure again. See the here, the see the visa take. Next one. Cost of debt. Cost of debt is how much? 0.11. 11% paid for how much of capital structure? How you can identify it now? 40% or as 40,000 divided by 100,000. That is 40%. And then tax. We need to consider the tax here. KD after tax rate is 0.4. Third one, cost of equity. Cost of equity, how much we are paying? 17%. Multiplied by the value is 100,000. Out of this 100,000, how much is for the equity shares? Again, 4%. Three components. Now calculate overall rate that we are paying for these outsiders. What is the rate? 0.21, 0.1200. That means 12.4%. 12.4%. Online student, is that clear to you? First here, first you need to calculate the once after you identify the times, so then how you can identify the once after you calculate this KD, you have to multiply it 1 minus 3 and then take that answer and then multiply that entire answer with the factor star. Okay. So this is how we can find out the cost of capital lesson. Any question on this one? No questions. So then, we go to the next lesson. Investment decision. Right? Investment decision. We have already told for your assignment.
Yes,
Group assignments.
Yes.
All members are here. Before moving to the lesson, tell me, have you calculated the IRR? Have you calculated before moving to the next lesson? It is over. It is cost of capital over. The next lesson, investment decisions. Right? Okay, before moving to the investment decision lesson, tell me, have you calculated the IRR?
Yes.
Yes. Have you calculated the NPV?
Yes.
Have you calculated the ARR?
Yes.
Then have you calculated the profitability index?
No.
No. Have you calculated the payback period?
No. Yes.
Payback period, yes. Yes, yes. And then the discounted payback period, you already calculated. Except profitability, you calculated all the things, right? So you have 40 minutes, right? You have 40 minutes. You can go to the lecture note and then one by one do the calculation and upload to the LMS. Right? If you have any questions, you can ask me. So this is how we costing last year write it down. There are write it down. There are 4 decisions. There are 4 decisions. There are 4 decisions. 4 decisions. There are 4 decisions in finance. First one, investment decision. Investment decision. First one, investment decision. Second one, working capital management decision. Working capital management decision. Third one, capital structure decision. Capital structure decision. Last one, dividend decision. Dividend decision. Hereinafter, within remaining 4 weeks, we are going to discuss the major 4 decisions. I hope you don't have previous experience with these 4 decisions. Even you have experience with the risk calculation, variance, and other things. These are really important. For not only this semester, for the corporate finance subject in the 4th year, first semester, it is a core subject having a 4 credits. Right? Okay. Now make the heading investment decision. Make a local lesson. Investment decision. A major heading. Full name. An investment decision.
Say, for them, stress management short breaks.
Okay, I know. Here registration numbers करतात. Registration numbers करतात. आवाला प्रश्न आहे मला केले. वाला सीए लाइब्रेरी तीन कोटियान Colombo. Okay, separate area Colombo. CA area Colombo. CA area separate area. CA library product. Business finance circle subject circle product. In all recommended ratings product. CA library. Okay, we start. Internship කියලා කියන්නේ subject subject. ඔයාලා semester එක තුල පටන් ගන්න. අපි කලින් subject කරන්න බෑ. ඔයාලට financial accounting sorry corporate coding දැන් කරන්න බෑ. ඔයාලගේ semester එක පටන් ගන්න දවස් නම් තමයි internship ඉස්සරහට ආවේ. Era manual sign करा articles का वेरीफाई ना Ini sih kan dia kalau kita dengar pindah kalau ini itu kosa ini kalau dia ada itu pindah simpel So we are going to discuss about the capital budget decision. Right? By looking at these pictures, you can identify what you mean by the capital budget decision. Okay. Now back to the lesson. Investment decision, or we can name it as a capital budgeting decision. Capital budgeting. What do you mean by the capital budgeting decision? What do you mean by the capital budgeting decision? Investment in wealth. If you are going to invest or if you are going to purchase a fixed asset, or else if you are going to make an investment, as a finance manager, as a CFO, you need to identify whether we are going with this investment for the fixed asset. Right. So you have to evaluate this decision. Is this worthwhile to invest or else not to invest? It is determined by the investment decision or the capital budgeting decision. Right? Okay. So what are the characteristics of the capital budgeting decisions? If you are going to acquire a new building, is that a capital budgeting decision? Yes. If you are going to acquire the land, is that a capital budgeting decision? Yes. If you are going to acquire or if you are going to initiate some new project, is that a capital budgeting decision? Yes. Right? Capital budgeting decisions impacting for the profitability. Are you agree with that? Yes. How? Profitability. If we make an new investment, definitely it generates the profit, or sometimes it might be loss. So therefore, capital budgeting decisions directly involving in the profits or profitability of the organization. Plus, it's linked with the liquidity position of the business. Do you agree with that? Yes. How? If you are going to make an investment, definitely you have to utilize the current funds. Current funds. That means you have to expense the cash in hand. If you don't have the funds at the moment, what you can do? You need to raise the capital. Go with that new investment, you need funds. How you can identify these funds or how you can acquire these funds? You can go to the bank and obtain a bank loan. And then purchase a computer. Right? So therefore, if you don't have the banking facilities, you can issue the shares. And then by issuing the shares, you collected the funds, and then collected funds can be utilized for the purchasing of a new equipments, fixed assets. Definitely, therefore, capital budgeting decisions impacting for the liquidity position of the organization. Plus, not only the profitability, equity, it impact for what? Shareholders' equity. What do you mean by shareholders' equity? How you can calculate shareholders' equity? Shareholders' equity can be calculated. Shareholders' wealth. Shareholders' wealth. How you can calculate shareholders' wealth? Shareholders' wealth be measured by the market price of a share multiplied by the number of shares. Market price of a share. If you have, as a company, if you have invested, if you made the investment, is that impacting for the market price of the share? Yes. How? It gives us a signal as a shareholders. If the company is if the company is going with a new investment, it hints the investors whether the company is moving or not. Right? So there, we can look at this annual reports and then identify what the company is moving now. Definitely what happened now? Market price of a share may be changed. If the market price changing means definitely what happened, shareholders will changes. So this is how the investment decision impacting for the shareholders will. Therefore, we have to identify the weight of this investment decision. It directly linked with the shareholders' wealth and then profitability plus the liquidity of the organization. This lesson directly linked with the previous lesson, cost of capital. Okay, so therefore we can identify, based on the purpose of investment, we can identify 4 investment types. What's the first one? What is the first one? Expansion. This investment decision might be an expansion. It might be an acquisition of a new asset. It might be a replacement, or else it might be sometimes modernization, modifications to the existing capacities or existing asset. Right? Based on the other one, what is it? Based on the relationship. You can identify this investment decision, capital budgeting decisions into 3. Mutually exclusive projects, independent projects, and then the other one, contingent projects. Mutually exclusive projects. What do you mean by mutually exclusive? Just assume we have two projects. Selection of one project definitely causes to the rejection of the other project because of some limited factors of the organization. We call it as a what? Mutually exclusive. Other one, independent project. Selection of one project is not dependent on the other project. Independent. Third one, it is something new to you, that is the contingent projects. What do you mean by contingent projects? Again, just assume there are two projects, project B and project A. To select the project B, definitely you have to complete the project A. And therefore, we can identify the contingent project means the selection of the other project is entirely dependent on the selection of the previous project. Right? So these are the 3 projects: mutually exclusive, independent, and then the contingent. We have a decision criteria when we are evaluating this investment decision. Definitely, these evaluation criteria are based on these investment types, based on the relationship. So therefore, you have to consider these 3. You have to remember these 3 when it comes to the evaluation criteria. 3 features of the investment decision. First one, what is it? It's a long term. It's a long term, and then we are sacrificing the current funds, plus it generates the future cash flows. So we can identify that as an investment decision or some kind of an investment. So you can read the importance of the investment decision because of the growth, because of the complexity, because of the irreversibility, as well as because of some of the other complexity funding. It is very much important. Right? Can we reverse the investment decision once we started it? No, you can't. Is that a complex one? Is that a complex one? Investment decision is a complex one? Yes. Why not? Why not? Once we taken that decision, can be reversed? No, we can't. Plus, can we just identify this cash flows and other things? No, you can't. You have to identify it in detailed context. Identifying some expenses and income are really difficult sometimes. So therefore, investment decision plays a crucial role in this finance management field. When we are taking this investment decision, you have to apply 3 steps. Right? What is the first task? Regarding the scenario, you have to identify the cash flows. First one is that you have to clearly identify the cash flows. Cash flows might be how you can identify these cash flows based on the relevant and the irrelevant cash flows. How you can identify the relevant cash flows? For the investment decision, we just consider about the relevant cash flows. What are these relevant cash flows? How you can identify the relevant cash flows? Yes. Definitely those cash flows are future oriented, and especially you have to remember this one. If any cash flow increase in future because of this new project, you have to consider that cash flow to the investment valuation. Right? So therefore, are we going to consider the irrelevant cash flows which are already incurred? We call it as sunk cost, and then which I have already identified, which are not in the cash terms, depreciation and amortization and so on. Do we need to identify those things in the cash flow consideration? No, we don't. That's the other one. We have some committed costs. That means already the fixed cost, such as legal cost. Therefore, we don't need to consider those things because those are not incremental things if we initiated this investment. The first task, you have to filter the relevant and irrelevant cash flows and clearly identify which sort of cash flows relevant for this investment decision. That is the first task. Once after you identify the cash flows, second one, apply the required rate of return. If you remember the R discount rate, then you have to identify the discount. Third one, what is it? Decision criteria. Therefore, write it down. Write it down. There are 3 steps. There are 3 steps. 3 steps in investment evaluations. In investment evaluations. Step number 1, identify cash flows. Identify cash flows. Identify cash flows. Second one, within brackets, write it down. Identify the cash flows, within brackets, write it down. You need to consider relevant and the irrelevant cash flows. Relevant and the irrelevant cash flows. Even some question include the irrelevant cash flows, don't take those things. What we are considering is what we are examining is your capability in selecting the cash flows. Don't take the depreciation. Right? Likewise. Second one, step number 2, apply the discount rate. Apply the discount rate. Step number 3, decision criteria. Examine the decision criteria. Examine the decision criteria. Right. Examine the decision criteria. Now draw it with me. Right? This is the mind map for your listener. Investment. Investment ethics. Investment techniques divided into 2. First one, investment techniques. Discounted cash flow techniques. What is the other one? What is the other one? Non-discount. Non-discounted cash flow techniques. Discounted cash flow techniques and then the non-discounted cash flow techniques. Name implies discounted means what do you need to consider? In this set of final techniques, you have to consider what? Present value, PV, present value of all cash flows. Present value of all cash flows. To identify the present value, what do we need? To convert the future cash flows to present context, what do we need? We need R. If you remember, R. R equals discount rate. What are the discounted cash flow techniques now? Yes, what is the first one? Very good. Net present value. What is it? NPV. Write it down first one. NPV. Net present value. Under the dividend, under the discount, the cash discounted cash flow technique. First one, net present value. Second one, internal rate of return. Internal rate of return. IRR. Third one, profitability index. Profitability index. Profitability index. Profitability index. Within brackets, PI. Profitability index. Fourth one, discounted payback period. Fourth one, discounted payback period. DPB. That. For the non-discounted cash flows, are we going to consider now the present value of all cash flows? No, we don't. So therefore, do we need the R? Do we need to consider R in these techniques? No. We don't need the R. Now write it down below the non-discounted cash flow technique. What is the first one then? Payback period. Write it down under here. Write it down here. Payback period. Payback period. Payback period. Payback period. That's a non-discounted cash flow technique. Second one. What is it? Accounting rate of return. Accounting rate of return. ARR. ARR. Right. Okay. Now, this is the overview of this lesson. Now, I already uploaded. Now listen. I already uploaded the handout to the LMS. Right? There are 8 questions. There are 8 questions. Next week also sometime it might be a holiday for the 27th. So therefore you have 2 weeks period. Even you have a 1 week period. This means already these calculations were done by previous lectures. as a homework, as an assignment, right? Or you have to go through these notes. Now listen, go through the notes and go through the previous note. So these are really easy calculations, right? Go through the note and then do it manually. Manual calculated techniques, calculation needed to be uploaded to the LMS before the next lecture. Sometime it might be the next Friday or Saturday, not Saturday. Sometime it might be the after the next week. Anyway, before the next lecture. Either Lila, I notes Balada, we gonna attack the other, gonna show the LMS upload. Right? Okay. Now we'll mark the attendance. Do it manually, yeah. Calculations, other upload करते हो. Don't need to worry, I will do it from the class, but you have to do it. Calculate the students here. Now mark
Sorry, sir, madam. 24.
24.
Is Agami Tina Yama Kanaka 25?
25. Hope you are mark the attendance. Any issues in mark the attendance? Asal kita ekor kan online lamanya dah kan mawat tekar dah ekor kan iya dengan aku ini isi tekar nak ini sangat kalau nikah dan diri kita